Good evening, colleagues, and a warm welcome from a not so warm Johannesburg. Thank you for being here with us tonight. We're just waiting for our numbers to pick up. We seem to be hitting 300 already. There's over 600 delegates, close to 700 delegates registered for tonight's webinar. So our sense is that we should get over 500 for a very important topic on business assurance. We're sitting on 310 and climbing gradually. Whilst the numbers are picking up, I just want to go through some housekeeping rules for the night. You'll see at the bottom of your tab, there's raised hands. Please refrain from using the raised hands, but rather type your comments and questions in the Q&A tab. We will monitor the Q&As, the questions throughout the evening, and our speaker will answer them as soon as his talk is over. The CPD certificates for tonight will be loaded onto the SADA platform. If you're not a SADA member, you can still register for an account and you'll have access to your CPD there. Tonight's event qualifies for one ethical CEU point. This event is also live streaming on YouTube. So for if any reason you cut off the live Zoom, then you're welcome to follow us on YouTube. Also a kind reminder to please complete the evaluation form at the end of the webinar. We take the evaluation very seriously and we share it with the people with PPS for them to obviously take into account and do better webinars going forward. Also at this point, I'd like to make the colleagues aware of the two webinars, SADA webinars coming up this week. On the 26th of May, which is tomorrow, SADA and the Strauman Group are proud to host Dr. Ridwan Haffajee with his topic on the timing of implant therapy and fixed prosthodontics. And then on Thursday, the 27th of May, the SADA's Great Awakening series, the fourth installment with Sarah Hornsby, who's a speaker coming to us live from the USA, and her topic will be myofunctional therapy in dentistry and airway health. We're close on to 400 delegates now. So I think Mr. HP is going to get started very, very soon. Just to introduce HP, Mr. Toerien is a technical specialist within the investment and insurance industry for 8 years, working with high net worth individuals. Hopefully many of you colleagues out there in the local as well as offshore markets. He has an extensive background in investments and retirement planning, and having gained experience in accounting as a group accountant for some years, HP is well placed to assist individuals with holistic planning with a strong focus on retirement, estate planning, investments, as well as business planning and analysis. He specializes in the analysis of scenario planning of personal and business portfolios, as well as tailor-made solutions for more complex cases. I know some of you colleagues that have been in the industry for quite a long time. You may have a fair amount of investments under your belt. So I think Peter is the man to guide us on how to go from kind of the basics to quite advanced portfolios. So Mr. Toerien, without any further ado, the platform is yours.
Thank you so much, Dr. Mansoor. Just to confirm, can everyone see my screen that I'm currently sharing?
Yeah, perfect. We can see your screen. Thank you.
So tonight's conversation or webinar would be based on business assurance and how that pertains to your practice, to your company as a person working in the dental profession. So the main thing, first of all, to introduce myself would be I'm part of a group at PPS. We called ourselves the Specialist Support Services. So that means I am a technical specialist in a specific area. As Dr. Mansoor mentioned now, I specialize in business planning as well as investments. But at PPS, we offer our members deep specialists in any area of financial planning, whether it is estate planning, whether it is a business assurance, investments, anything pertaining to your financial needs. We'll have a deep specialist that will be able to assist you. And that's free of charge to any of our members. So the main thing with business assurance, where a lot of people would do it, especially in the medical professions, is I know this type of assurance or risks exist within my practice, but there are so many various things my biggest question would be where's the ideal place to start? How do I approach this thing? What's the first steps to do, and how do we go through this process? So first of all, let's define business assurance. So business assurance is a risk assurance that you take out for the company or for the practice, and that basically covers all the potential risks that you might have, whether it is one of the partners or somebody that's essential to the business to pass away or become disabled or not being able to function in his day-to-day working activity. And business assurance is there to provide certainty as well as liquidity within the company structure to make sure that the succession plan of the company is looked after, to make sure that the company can continue to exist, so the practice does not fall behind. And there are quite a few solutions that we will look at tonight. Now, first of all, is the buy and sell agreement, key person insurance, contingency liability, as well as credit loan cover. So the person, when we look at business assurance, can either be an owner of the company, a director, or even an employee. It does not necessarily mean that the person that the risk is pertaining to have to be one of the business owners. Now, one main thing that a lot of people would know is the old saying that it's not personal, it's business. But when you are a business owner or a practice owner, it's actually the other way around, because this is not only business, but it's also personal, because this affects my own personal estate. Not only that, but also the legacy that I leave for my beneficiaries at the end of the day. So business, when you're a business owner, it's actually very personal as well, because you've worked all your years to build up this empire or this legacy that you want to leave for your beneficiaries at the end of the day. And it becomes a personal matter. And therefore, it's very important to make sure that everything is looked after properly. So first of all, we'll look at contingent liability. This is usually one that pertains to most companies. And how this works is, say, for example, we start off a new practice, or we want to expand the practice, or we're opening up a new branch, etc. And we need to fund that practice to buy all the equipment that we need, or to take a loan out for the property, or whatever the case might be. Therefore, we need to take a loan at the bank. And a lot of times, especially when we're starting off a practice, we do not have the funding to just fund it ourselves. And therefore, we need to take out a loan from the bank. And the problem with that is usually there aren't any financial statements available because we haven't done any business yet. So then the owners or the future owners of the company needs to sign personal surety with a bank for them to obtain this loan. So what happens is the bank would look at your personal finances, and because of that surety, they would then provide you with the funding to start off this process. The problem with that is when we look at, let's just go back to that slide. When we look at this process, it's quite simple in the essence that we can obtain this loan, but what happens if something happens to the person that signed the surety? So how does this involve your personal estate? So the money lender, which is in this case would be the bank, may legally call upon the personal estate of one of the persons or all of the persons that signed surety when the debt isn't settled timeously, or there's no suitable replacement in the event of the original surety's death, or the failure to make an alternative arrangement. So a lot of people would say, yes, we are 3 shareholders. So for example, we've got a 9 million rand loan account, and I pass away, so I'm only liable for 1/3 of it. And that's not the case, unfortunately. The bank can actually look at the whole loan amount, and when something happens to any one of the 3 surety signatures, they can actually legally call upon your personal estate to settle that. So while all of this is happening, the main problem is your personal estate, because your personal estate would be delayed to be wound up. So your relatives, say for example, me and my wife has got I've got a practice, and my wife now, after I've passed away, that's a massive problem, because now she doesn't have any liquidity or any funds to carry on with life, as the estate can't be wound up because there's still a loan account within the company that needs to be settled before the estate can be wound up. So as you can see, it's not only the company that gets influenced by this, but also the personal estate is affected quite handsomely. So how do we solution this? Going back to a similar picture that we've got, the owner would sign the surety. So you would obtain security to show the bank that this is why I think that you would provide me with this loan, and the bank would look at the security that you offer, and on that basis they would provide the funding. But now to complete the circle or complete the flow is the owner would take out a policy. Actually, the owner in this case would be the company, would take out a policy on the various individuals that sign surety for this loan, and that policy would fund the loan account. So how does it work? Is if one of the surety holders or more than one of them gets affected, either passes away or become disabled, etc., that policy would pay out, and in that case, that policy proceeds can be used to settle the loan account, and therefore the estate of the deceased party can be wound up. The loan agreement can be finalized, and the company can proceed without any liquidity issues. Now, one very important thing to take note of is at the bottom, I say here, there must be a signed agreement in place. Why is that so important? Now, in essence, when I have a policy, anyone would say, well, the loan is settled, so I'm fine. But the problem is the remaining shareholders, they are not forced to use that proceeds to actually settle the loan account. So what you'll have is a company that would have a loan account of, say, for example, 5 million, and one of the shareholders passes away, but they have liquidity within the company, and they think, well, let's rather just keep on paying our installments and take those proceeds and go have a Mauritius holiday or whatever the case might be. So what becomes a problem is later in life when they fail to pay the premiums, etc., then your estate is still, you are still, as an individual that signed surety, liable for that loan to be settled. So the agreement actually forces the remaining shareholders to use the proceeds to settle the loan account. If there is any surplus, then they are free to use that within the company as they see fit. But what's nice about the agreement also is it releases you from the surety that you've signed. So even if the company then takes out any further loans, etc., your surety has been cancelled in writing, so the bank does not see you as one of the sureties of the company anymore. Okay, so how does this policy get structured? Is the business will be the policy holder and the payer of the company, and the business will also receive the proceeds. So it won't be the shareholders in the individual names, but the business itself. Why is that? Because the business is is in essence the legal entity that's liable for the loan account and the sureties after that. So the life insured will be the one who stood surety for a specific loan. So if I've got 3 shareholders that all signed surety for a company, I'll have 3 policies, one for each individual, and that will be to settle those specific loan accounts. Secondly, we look at credit loan account. So it's very similar actually to a contingent liability in the sense that this also links to a company when we had funding, but in this case, the funds weren't from an external party, but from one of the owners or more than one of the owners themselves. So say, for example, Nathan is a dentist and he starts his own practice with 2 other parties, and they want to buy furniture and equipment for the practice, and Nathan actually uses some of his own money to loan to the business. So there would be a loan account on your financial statements in Nathan's name, and that loan account needs to be settled should something happen to Nathan in order for, first of all, to wind up the estate and to make sure that all the debt has been paid back to the relevant party. So in this case, we actually have 2 solutions that we can do. We can either have the business repaying the loan. So if I've got a loan account with the company of about 500,000, then should I pass away, the company would then settle that loan account of 500,000 Rand. Or we can have a partner buying the loan account. How that happens is, say, for example, we've got 3 partners, and Nathan and myself and another individual have this company, and Nathan passes away. I can actually take over his loan account, and so the loan won't be settled within the company, but then basically I would pay for that loan account. So the 500,000 would come out of my pocket, or with a policy solution to continue. So on the one side, when the business repays the loan, the company would have a policy to fund this obligation. So that would be very similar to the contingent liability that we just discussed. Should a partner buy it out, so that could be included in the buy and sell agreement. So whilst I'm buying the shares of this deceased party, I also buy his loan account. So basically that gets transferred. It's an accounting principle. So the auditor would just change the loan account to my name and not the deceased party's name. So when the business repays the loan, that obviously improves the net asset value of the business because that liability has been settled. So that you need to take note of that the asset value of the company would be increased. Where when the partner buys the loan, usually that's the case. Is most of these credit loan solutions would be one of the partners would take over the loan account, and that company value would stay the same. When a business repays the loan, premiums will be payable by the business, and when a partner buys it, the premiums would be payable by the partner. So on the one side, when we have a separate solution and the company takes out the policy, that would be subject to estate duty. And when it's part of the buy and sell agreement, it might be exempt from estate duty. So those are all things to take into account. And it's because of that last point that most people prefer to include that in the buy and sell agreement, so we can be exempt from estate duty. But the benefit of having a separate policy is sometimes the premiums can be deductible as well. Once again, the correct policy structure must be looked after. So if you're looking for a policy structure where we do not want the net asset value of the company to be increased, I can't take a separate policy out. I need to put that as part of the buy and sell agreement. So these are all various things that needs to be discussed when we look at a credit loan account or when we do a business needs analysis for your practice or for your company. Okay, so how a credit loan account would be structured. It will either be the business, the policyholder and payer and receive the proceeds, and the life insured will be the creditor, as I mentioned here, or when it forms part of the buy and sell, then the various partners that would take over the loan account would be the policyholder, payer, as well as receive the proceeds that would pay out then basically to. So in essence, the business or the remaining shareholders would receive the proceeds from the policy, but then those proceeds would be used to pay the deceased estate. So at the end of the day, the flow of money would end up in the estate of the deceased party to settle that loan account. Now, I think probably one of the most important parts of business assurance would be the buy and sell agreement. Now, what is a buy and sell agreement? That's usually when we've got more than one shareholder. Not always the case. You can even have a buy and sell agreement if you're only one business owner. So if you're a one-man show, this is also still pertaining to you, but I will explain the differences a bit later. So for example, in this case, we've got Tabo and Brian, both owners of the practice. So they've got a memo of incorporation or a partnership agreement, or they're part of a CC. There are various, and all of depends on the different type of legal entities. I know mostly within the medical industry, we make use either of a partnership or a company, depending on what type of services you deliver. And they've got a contractual agreement then to buy each other's shares should anyone of them pass away or become disabled and unable to do their job anymore. And usually they'll have an insurance policy to fund the purchase of those shares. So how this works in essence is a few questions that we need to ask when we look at a buy and sell agreement. So what happens to the business if one of the owners or more of the owners pass away? And how will this affect the remaining staff as well as owners of the company? With regards to liquidity as well as the run of the business, etc. But not only that, you should also ask the question, how will this affect the deceased's family, the deceased's estate? And the problem usually is when we do not have a policy in place is what happens if you can't sell the business. So I've got this problem at hand because I can't wind up the estate. I can't actually buy the shares that I need to. And I know in the medical professions, that's also a lot of times you can't have a shareholder within your company that's not part of the regulatory board or the council or whatever the case might be, depending on what type of industry you're in. And therefore, you can't have a relative or somebody that receives the shares from the estate as a shareholder because he doesn't have the necessary qualifications to own a share in this practice or company or partnership. Okay, so it's not necessarily that you can say, well, my shares would just be inherited, because sometimes that's not an available option because of other regulatory issues that you can have. And then also, what happens if a surviving partner, if the surviving partner inherits this? And that's also the case, is the skills of that individual. Now, even if you have a regulatory board and everything is okay, you don't necessarily want somebody that inherits these shares and they don't have a clue what's going on with the company. And now you've got a problem, because legally they can actually be a shareholder and sit in board meetings, etc., etc. And that causes a lot of problems. So therefore, we do not only have the policy in place to buy the shares, but we also have a buy and sell agreement. Now, what the buy and sell agreement entails is, first of all, it creates certainty. So first of all, the purchase price. So that helps you when you're looking at your personal estate. So I know if something happens to me, this is the ballpark figure that I'm looking at. Should I pass away, this is the amount of money that my estate would receive, and that can be left as an inheritance as I see fit. But then I can put a price tag on it so I can do my personal estate planning. Then second also is the method of payment, how this would be paid. In most of the cases, that would be by the policy. Sometimes when somebody becomes uninsurable, there will be either an investment account or whatever with funds that would be used to settle that account. And then the duration of sale. That's very important, because that determines that the estate can be wound up. If you do not have the agreement in place, it makes it a lot harder. I can almost relate this to in a personal capacity. If you do not have a last will and testament, it's much more difficult than to wind up everything. When you've got the buy and sell agreement in place, it almost acts as the letter of wishes of the company. So knowing exactly this is what happens with the shares should something happen to one of the shareholders. Okay, and there's quite a lot of advantages to the personal estate as well. Is you can clearly calculate your capital gains tax as well as your estate duty when you're doing your personal planning, as well as you can improve your estate liquidity, as you can structure the buy and sell agreement in the sense that the policy would not be estate dutiable. So there's quite a good saving on that as well if this agreement is structured correctly. So as I've mentioned earlier, a buy and sell agreement, we can also call that almost like a business owner's will. How does this compare to a will? It's actually also a legal document that must be structured correctly and dated and signed, similar to what a will should be. That is basically a reflection of the company's wishes, what would happen, and that needs to speak to the memo of incorporation of the company as well. And that needs to be reviewed regularly as the purchase price is discussed within this document, as well as the duration. So anytime when there's a change in shareholdership or when the company's value has changed, everything like that, then we need to review this to make sure that everything is up to date. Also, it needs to be stored in a safe place. That's usually kept by the auditor as well as your financial advisor or broker that looks after you, to let everyone have a copy, as well as each of the shareholders to have a copy at home. And then this is for the benefit of your family as well as for the company at the end of the day. Then the last part of cover that we will look at is key person cover. So how does key person cover work? Say, for example, we've got an individual, Thandi. Thandi does not necessarily have to be one of the business owners. She does not need to be a person that signed surety within the company or have used some of her own funds to borrow to the company. Thandi can be a locum, Thandi can be another dentist or admin person, etc. within your company, but that person needs to have must be a massive company asset, somebody that is essential to the running of the business, to the success of the business. So Thandi can be either one of the doctors, and if something happens to Thandi, then the profits of the company would take, the earnings of the company would take a massive knock. Or Thandi can be an individual that has quite important relations with key stakeholders. For example, if you're a dental type of practice that does not only do dentistry but various other things, she can be the key marketer, she can be the influencer, getting people to the practice, etc. So that needs to be insured. So how do we ensure something like this? That can either be a replacement and a recruitment cost. So if Tandy passes away, to replace Tandy and to recruit somebody, as well as the loss in operating profits and also the costs involved to replace Tandy. So it can be either or a combination of those things. How does this policy work? So first of all, let's just go back to that slide again. We would look at either a multiple of between 1 to 7 times of Tandy's salary if it's to replace her. First of all, that is to be able to recruit somebody new, to skill that person, to upskill that person, to do that. And we also can do a calculation to say these are the accounts or the amount of clients that Tandy was responsible for in the company. If she passes away, we would lose that flow of income, and that would be an operating loss for us, and we can insure that operating loss. So the policy that we would take out on Tandy's life would be a company-owned policy. The company would pay the premiums for that policy, and the proceeds would also come to the company. The premiums that you pay can either be deductible from the income that the company has made throughout the year, but then you should note that the proceeds would be income taxable. But we advise rather have the proceeds not taxable, but then you won't be able to deduct the premium. So it's an either or situation. Most of the cases we do not deduct the premiums, and then the proceeds would be not income taxable. So sole business owners or single business owners, as I've mentioned earlier, this type of cover would also be pertaining to you. First of all, as you would imagine, so if you sign surety within the business, that those contingent liability covers needs to be paid. If you've loaned or borrowed some of your own personal money, but also even a buy and sell. So how would that work is usually I'll have a dental practice when I'm the owner, but I've got 1 or 2 more dentists working with me. So then in that case, I need a succession plan. I need to have somebody that would take over the company should something happen to me, look after my clients, etc. It all depends on exactly what the company structure is. A lot of times people would say, in the medical professions, some of the practices, if I'm not there anymore, the patients won't be there anymore either. But it all depends on how the practice is structured. And a lot of times when individuals work in tandem, sometimes you get a father and son practice. A lot of times those patients would then go to the son should the father pass away, etc. So the major thing to consider is, first of all, the format of the business and the practice to make sure that the business can continue. And that's the important thing is the succession plan is to make sure that if something happens to me, I want the companies to still continue because there are other individuals that also depend on the income from this company, other people working for this company that needs to be looked after. And I need to have a succession plan in place. So even if I'm the sole owner, I know one of these dentists would take over, or more of them would take over, and they would take over the company in various proportions. That all is dependent on your personal preferences and your personal succession plan. Some people would also say, even though the patients would not necessarily stay with the practice, all the furniture, all the equipment, everything that we've purchased, the practice would still remain, and the dentist that remains would build on their own practice as they would have their own patients already. But then they can continue with the business without having the issue of liquidity when it comes to paying salaries for all the admin personnel, for the rent of the property, etc. So all of these things needs to be looked after. And another thing also is, even if the practice would cease to exist, is the winding up or deregistration costs of that company. There are costs involved, and sometimes it's important to make sure that that's covered on a policy. Sometimes people would leave a severance package for individuals. Say, for example, I'm a sole owner, but I've got 2 admin ladies that work with me. Then the thing is, if I pass away, both of those admin ladies would then be without a job. And a lot of times those individuals have worked quite a few years for you, and we need to make sure that they are also treated fairly should something happen to you. So A sole owner can also benefit from these type of policies in various ways. Okay, so the business assurance needs that we've addressed throughout the discussion today was the contingent liability, as well as the credit loan account, the buy and sell, as well as a key person risk cover. Now, what most people would say, I know that I've got loans within the company and we're more than one shareholders, and I might have a locum that's very important for the running of the business or another individual in the company. But this is so much information. I don't know exactly where to start and where to stop. How much do I need to provide for estate duty? How should the policies be structured? Who can help me with the agreements that needs to be set up? All these various things. And that's where a full business needs analysis I would recommend. As PPS, we offer this service free to our members, and dentists all qualify for PPS. So if you're not a member yet, you're more than welcome to contact us with your business needs, and we can definitely set you up with that. We would help you to do a full business needs analysis. So we would set up a meeting with you. We'll look at the various risks involved in your practice, look at your financial statements, look at how the company is structured, look at all the various shareholders involved, look at all the key persons involved within the company, as well as any other specific needs that you might have within the running of the company. We would set that up in a document, and then after that, we would identify all the risks involved to your specific practice and have a discussion with you, and then see to solution them appropriately, to look at things like estate duty, to look at things like policy structures, look at the agreements to make sure that all of these speak with, for example, the memo of incorporation, speak to your specific needs as an individual. A lot of times we'll have more than one shareholder, but only one of the senior shareholder, if I can call it that, would like to remain in control of the company. So not necessarily all the various shareholders would buy those shares proportionately. Sometimes only one would. So all of these different things needs to be addressed, and that we all compile into quite a substantial document to make sure that everything is looked after. In this document, we would also discuss all the various tax implications into an easier read document, as well as a summary in the beginning. So it's not necessarily that you'll have to have hours to read through everything. We can present all of that to you, as well as to any individual that's pertained to, like a key person, for example, to make sure that they also know exactly what needs to be looked after and how, etc. Basically, that is all pertaining to business assurance. And if there's anything specific that you want me to cover in more depth, or if there's any specific questions, please make use of the Q&A functionality. As well, Dr. Mansour, if there's anything else that you think I need to elaborate more, please feel free to discuss this with me.
HP, thank you for that. If maybe in the next 5 minutes, you can do a quick summary of the key elements that we've touched on, the key man, the loan account, just a quick overview, because there's a lot of important content that you've covered here in a short space of time. And I think it's something that a lot of dentists don't think about. What got me is obviously the whole issue of the loan account, and how when you die, your loan account becomes part of your estate. So I think maybe let's just touch on that a bit more, because I think many of our colleagues have loan accounts in their practices. To bring capital in, we loan money to the practice, right? And we keep it there for years, not knowing what happens the day we're not around. So maybe just a few more pointers on that. I think that's important. Thank you.
Great. Okay. So first of all, as we discussed, let's run through them again. Is the first two type of covers we'll have is where money has been lent to the company. So the company actually owes someone money. So the first one would be contingent liability, and that is when we have a bank that provides the funding, and that's where we sign surety. So in the essence there, we need a policy as well as an agreement in place to make sure that this has been covered. One thing to take note here is, because the business owns this policy, there would be estate duty payable on this policy. So say, for example, I've got 1 million rands worth of debt that I need to settle. The policy should actually provide for 1 million as well as 20% estate duty. So in essence, the policy should be 1.25 million rand. So if the 20% gets deducted, the net amount would be 1 million. and that is to settle that loan account. The main thing about this is, should something happen to me, the company can come to my personal estate. And that's why it's important to make sure that this type of policy is in place, as well as the agreement to make sure that that surety gets cancelled in writing. Okay, so the important thing also is when you yourself borrowed money to the company, as Dr. Mansour mentioned now, that's mostly the case with dentists. And an interesting fact actually is a lot of times when an accountant looks at the books, they would rather keep the loan account running, as that is a nice way to do the accounting to make sure that there's not unnecessary taxes being paid in a specific year. But at the end of the day, that's still a liability on the company's books. So should something happen to you, that liability in the company is actually an asset in your name. So that needs to be settled, and that can have an estate duty effect if it's not settled with a buy and sell agreement, as I've mentioned. So if that's settled by a separate policy, once again, you need to add the estate duty to make sure that that asset that's now in your personal estate would not be estate dutiable, or the estate duty that would be payable on it would be provided for. Okay, as I've mentioned, we've got the two structures, either the policy, as I mentioned now, or we include it in a buy and sell agreement. That's usually the case when I've got more than one shareholder. So the loan account would remain. Accountants like this as well, because then they still have the option to do accounting in a way that the income tax at the end of the year is at a minimum, to make sure that everything is done legally, but not to pay unnecessary taxes at the end of the day. Then after that's the buy and sell agreement. This is usually pertaining to companies or partnerships or practices that have more than one shareholder. And that's basically to have an agreement between the various shareholders or between the various partners to make sure that everyone knows exactly what happens should one of these partners pass away or become disabled or not being able to fulfill their duties as a shareholder in the company. Also, to make sure that the remaining employees as well as the remaining owners are looked after, as well as your deceased estate is looked after. So this just creates certainty to make sure this is the plan of action. Should something happen to one of us, this is the way forward. This is how we're going to solve this, and to make sure that my personal estate can be wound up and be calculated accurately, as well as to make sure that the company stays afloat throughout this. The agreement that goes with that, that's a buy and sell agreement, what we call it. It's basically like the letter of wishes or the business owner's will, and that's just to structure everything correctly to make sure that the wishes of the company is looked after. Key person cover, that is where I've got an individual, not necessarily one of the shareholders or partners in the company, that's essential to the running of the business or essential to the success of the company. And we can actually ensure that individual against any potential losses that we might incur to replace this individual or to recruit someone else, or if we do not wish to replace that person, to recover the losses that we would incur for having one less person in the company. Single business owners, as I've mentioned earlier, even a buy and sell agreement is pertaining to you. The major thing there to look at is your succession plan, to make sure that the remaining members of staff or the people that remain in the company or your successor knows exactly what to do, where everything would be, how it would be structured, or if the company would not continue, to make sure that the winding up or the deed registration of the company is done correctly. Main reason, therefore, is to make sure that the personal estate can be wound up, so it's not a long and tedious process. And as I've mentioned, we do the business needs analysis. So if you've got any questions, if you're not sure which of these are pertaining to you specifically, you're more than welcome to contact us, and we would do a full analysis of your practice, of your company, and explain everything in detail, all the things pertaining to your specific business. That would be everything from the risks involved, the way to solution these risks, as well as the necessary agreements that we need to put in place, as well as all the various estate duties and taxes, and how you can structure the policies ideally to make sure that everything is looked after correctly.
HP, I think going through it a second time really hits home a bit better, right? Because even I now have a better understanding of what you've just informed us about. So basically, assurance, I mean, is different from insurance. I mean, insurance is um, insuring the assets of your business. This is now on another level, assurance. So I think we need to bring that difference through. Um, what stands out for me is obviously the contingent liability that we don't consider. Generally, in sole practitioners, where there's only one practitioner, the buy and sell where you have other shareholders, and the key man where you may have other shareholders, but the key person is a long-term associate of yours that doesn't have shareholding, but yet brings in turnover. So every risk needs to be insured against. Extremely important topic. We've got a lot of questions that's come through. So I'm going to go through the questions one by one, right? And we'll maybe perhaps have a discussion around that.
Yes.
Okay, the first question from a colleague in Cape Town. I'm a sole proprietor who wishes to invest in additional equipment to the value of 1.3 million. What type of policy does PPS offer to settle the outstanding debt on the equipment in the event of my demise? So my assumption is that this would be a contingent liability situation.
Correct. That is correct.
So what policy should this colleague consider?
So first of all, you're 100% correct in saying that we need a contingent liability cover for the 1.3 million. But the important thing to note there is to have a contingent liability agreement as well, to have that in place. That makes sure that the surety gets cancelled in writing. So
who would that agreement be in place with? Would it be the financier, the bank?
So it basically would be an agreement between the company and the individual. So even if I'm a sole proprietor or a sole owner, the PTY Limited or the partnership or the CC or whatever the legal entity would have an agreement with the individual himself. So although the company representative and the individual in this case would be the same. That would be an agreement between the legal entity, which is the company, and the legal entity, which would be the person himself.
Okay.
To make sure that there is a full understanding of what happens with the proceeds of this policy and how this be settled. Why that is important to make sure that the estate can be wound up. If I do not have that agreement in place, then the person that handles the estate at the end of the day needs to go and look at what policies paid out in the person's individual name, what policies is paid out in the company's name, what debts are in the person's personal capacity, what debts are in the company, what duties are payable on the various. So it complicates everything.
Confuses it.
Exactly. So that basically resolves a lot of confusion for somebody that takes care of your estate at the end of the day. And a lot of times, the executor of that estate would not necessarily know exactly of all the various different policies you've got, all the various debts you've got. He only becomes aware of this once you start the process of looking at your estate. While you're still alive, he does not necessarily know exactly everything that's going on. So agreement makes sure that you know exactly where what is and for what purpose this serves, etc. Another thing also is to remember a contingent liability agreement is in the company's name, and therefore the company owns the policy, and therefore we need to make sure that we provide for estate duty as well, because this policy would be seen as a deemed asset in your estate, and therefore there would be estate duty payable on. So it would be the 1.3 million debt as well as 20% estate duty that you need to take into account.
So HP, is that assuming that it's a sole proprietor? If a colleague is registered as an incorporation, which is essentially a company, would estate duty be payable on that as well?
Yeah. So say, for example, I've got an incorporation or a partnership or a PTY Limited or a CC, and I've got 3 partners in the practice. And each of them have a 1 million rand policy for contingent liability. So individual will have a deemed asset in the estate of 1 million rand because the policy is owned by the company and not by the individual. So it's a different person who receives the proceeds. It won't be the individual himself. So your personal cover, your estate is basically the person that received the proceeds, where in this case, the company, a different person, It's like bequeathing things not to your wife but to your children. There's a estate duty payable. It's a similar principle that they use, and therefore there's a estate duty in your personal estate. So always when you do a contingent liability policy, provide for estate duty.
For the estate, okay, that's important. Okay, a question by anonymous. When it comes to the assurance that we've been talking about, can they speak to any PPS consultant, or do they need to ask for specific assurance consultants to be able to assist them?
They can ask for one of the business assurance specialists, which I am one of. So yeah, we have quite a few on our panel that services throughout the country. We are deep specialists because this is a bit of a niche field in this essence that you need to be able to calculate their duties appropriately to make sure that the agreements are drawn up. So it's not only a financial advice that we'll give you, but also a legal type of service as well, drawing up agreements, etc.
Okay. HP, I think after your presentation tonight, there's going to be many people asking for you, hey, so brace yourself.
No, that's 100%. That's perfect.
Okay. A question by a colleague, Dr. Vali. He wants to know if it's possible to obtain a transcript for tonight's very important webinar. So I can answer this. Dr. Vali, if you go onto SADA's YouTube channel tomorrow, this entire presentation will be made available on SADA's YouTube channel. Okay, anonymous attendee, if I am a PPS member and a dentist, but have other businesses as well, will PPS assist me with my complete business and estate, or just the dental business?
We will look at all the I've actually just helped a doctor just before we started with this call. We actually finalized everything 6:15 this evening. He's a doctor that also owns 2 restaurants. So we did for his practice as well as for the 2 restaurants. Assist him not only with the business insurance needs, but also with the commercial insurance, insuring vehicles as well as the property, etc. On the short term. So yes, we've looked at the whole portfolio. So we look at a holistic view when it comes to PPS. As a member, we'll look at all your various different businesses.
So basically, being a dentist, that's the ticket to the game. Once we're in, PPS will look at everything that we...
Yes, if you're a PPS member. So we also have sometimes, I'm a business owner and one of the shareholders does not necessarily qualify for PPS. That's not a problem. We'll still assist you with the whole analysis, with the agreements, with everything. It's just that when it comes to the insurance policies, if somebody doesn't qualify for PPS, that insurance policy needs to be taken out with a different risk partner. But we'll assist you with that whole process.
Wonderful. In the event of a practice being sold, is the loan account paid back to the seller before any tax is calculated on the profit of the sale, if any? So in the event...
So that's basically similar to a credit loan agreement in the sense that not necessarily if the business gets... someone passes away. So, for example, I'm selling my practice to somebody. They can either buy the loan account with it, or they can settle or the loan account can be settled before. And that's up to the seller and the purchaser.
Can the loan account be settled from the proceeds of the sale?
That can be done. Yes, correctly.
Yeah.
Correct.
Okay.
But remember, if the loan account is settled, the net asset value of the company is influenced.
Yes. Yeah.
Correct.
Can you comment on a one-man practice functioning as a sole proprietor and not a company, whereby capital outlay and bank loans are taken out in the dentist's personal capacity? So I think that has to do also with contingent liability.
Yes, that would be similar to a contingent liability, but as this is not a separate legal entity, as this is in your personal capacity, most of the times we can actually draw up a contingent liability cover for you, but you can even take out a personal policy and just cede the proceeds to the bank or to the relevant lending company.
Well, what would be cheaper? Which form of policy?
It's basically much of a muchness. It's the same type of structure. Usually, when you've got a company, you can't do it in your personal capacity, and therefore you take out business insurance. But if it's in your personal capacity, you can do either or. I would recommend other structuring in a way that you do a contingent liability, because then you can specifically split. Once again, when the executor looks and to wind up the estate, he knows exactly this policy is to settle my business loans, etc. This policy is for personal things. So it just simplifies it for the executor at the end of the day.
Yes. Okay. Another question. I have a life policy this is intended to settle any lab account outstanding. What is a tax implication?
Okay, so the policy I assumed would be ceded to the lab account and not to your estate, and therefore there would be estate duty payable.
Estate.
So
basically,
yeah. So sometimes what we get is I've got a life policy in my personal name, for example, for 5 million, and I only have debt of 1 million. So I partially cede that 1 million to the debt, and the rest I bequeath to my wife. So then only 1 million would be a deemed asset in my policy, and the 4 million that gets bequeathed to my wife would not have any estate duty. So it's not necessarily that the whole policy would be estate dutiable. Only the parts that get ceded or bequeathed to somebody other than my wife would have estate duty.
I picked up in one of your slides, you mentioned that we need to review regularly. And I think this is an important example because you may not have a 1 million rand liability your whole life. It changes as you move along in life.
Correct.
So your
loan gets paid off. Not only that, as well as the buy and sell agreement, a lot of times when we start off a practice, we've got the agreement in place. And then 5 years later, the practice have grown considerably. And then the purchase price, everything is determined within the buy and sell agreement. So even in the agreement, they would, for example, state if one of the remaining shareholders is unhappy about the purchase price, they can get an independent valuation done, etc., etc. But that whole process takes time once again. If it gets regularly reviewed, that won't be the issue. So there won't be anyone that's not sure exactly what would be the selling and the purchase price. So everyone would be on the same page, and that just avoids confusion and makes sure that everything is up to date.
So HP, from your experience, what would be a regular review? Once a year, once every 2 years?
I would say once every 2 years is fine, unless the practice has grown considerably or unless something major happens. So we've taken out a new loan, I would do a review. If we employed somebody new when we doing a key person type of insurance, I would do, when we onboard another shareholder or another partner, I would do a review. So anytime that something considerably happens, I would do it before 2 years. But other than that, every 2 years would suffice.
Okay, good. Is this service only available in South Africa? I'm not sure where this colleague is writing from, but I know PPS is in Namibia as well. So if he or she is in Namibia, then obviously they can contact PPS Namibia as well, hey?
Correct. Yeah, we even have, when you have your risk cover with PPS, even if you're offshore, I know a lot of individuals for part of the year they're in South Africa, and most of the time they're in Europe or wherever, you would still cover. We can still assist you with those type of policies. They're important.
Yes.
You still have your South African residence and bank account.
Yes. Okay, this is an important one. Do the subscriptions payable for PPS business policies contribute to profit share?
Okay, so we have launched business insurance profit share at the beginning of this year. So for all the buy and sell agreements that you've got, you qualify for what we call indirect profit share. Now, how indirect profit share works is similar to the investments that you'll have with PPS or the short term or the medical aid, where on your personal profit share account, there would be a line item to say the profit share that you've earned for your investments would be X, the profit share that you earned for your business insurance would be Y, etc. So you would get profit share on your personal capacity, and therefore it's important to have your personal risk with PPS as well, and then you qualify for profit share on your buy and sell agreement as well.
Okay. For a last question here, but this question is more for the short-term insurance division.
Okay.
Maybe you can answer it, maybe not, right? This is, how does the rates charged by PPS for business insurance compared to that offered by other insurance companies? I know it's risk profile dependent, but it's not an assurance question, it's an insurance question.
Yes, so I assume that is for insuring the furniture as well as the equipment, etc. So from all the presentations that I've actually attended, so it's very competitive, but there are various different risk metrics that they use when they look at short-term insurance, and I always recommend people when they're looking at short-term insurance is get a few quotations to see how it competes in the various sections. And usually with any short-term insurance, whether it's commercial or personal, it's quite a competitive environment. So we would definitely And remember, on our short-term policies, we also pay profit share. So sometimes the premiums would be quite similar to what you're currently paying, but remember that now you will earn the indirect profit share as well, which is
profit share. Okay, HP, that brings us to the end of our Q&A. Thank you so much for such an insightful topic. I mean, before this webinar, I myself didn't know what to expect. And you've kind of nicely put into perspective the different type of assurances that we need to look out for. So really, thank you so much for that. And we'll send you the feedback in the next day or two. I don't think there's any more questions. So I think at that point, we'll call it a day. But really, much appreciated. Thank you so much.
Only a pleasure. And if there's anyone that's got additional questions later on, feel free to contact me. Even if you do not specifically have a need to take out a policy, etc., more than welcome to help you to have a discussion, to come and see you if there's any questions. Even if you've got a practice with a few partners and you want us to do a presentation for you guys separately pertaining to your specific needs, we're more than welcome to do those type of presentations as well.
Wonderful. I think there's just a last question that's been slipped in. Let me have a look here. Okay, it's just a comment. Thank you from Dr. Spiros. Thank you for all the insights and information. Much appreciated.
That's a pleasure. Only a pleasure.
Thank you, HP. With that, we call it a day, hey? Or a night.
Thank you so much for everyone's time.